guys, it's Stock Hurry, and we just got some really bad news in the stock market. Friday and Monday could be the worst days that we see since March of 2020. In today's video, I'll explain what news just came out, and I'll tell you how to profit off of it. So let's get into it! So we actually got a lot of bad news on Thursday. Let me go through some of what came out and explain everything that's going on, and then I'll tell you how we're going to profit off of it. Thursday started with US GDP numbers coming in, and they fell at a 1.4% pace. That's right, GDP in Q1 of this year was negative. Now, what does that actually mean, and why is this such a big deal? Well, first of all, if the United States sees 2 quarters in a row of negative GDP, that means we are officially in a recession. So yes, there is a possibility we could be in a recession right now. However, there's some things that we need to consider here. First of all, the United States will have negative GDP quarters quite frequently, and it does not mean that we are actually in a recession. Remember, we need 2 quarters in a row to actually be in a recession. So right now, the markets are pretty much blowing this news off. However, there are some red flags, and I want to go through those. Now, the first red flag we have is obviously just the fact that GDP was negative. Economists were expecting GDP to grow by 1%, and instead it fell by 1.4%. Now, keep in mind that the way GDP is measured is by something called real GDP. And what that is they take the GDP growth and then they subtract inflation. And whenever you get into a situation where inflation exceeds the GDP growth, you have negative real GDP. And that's what's going on here. The biggest indicator in this report is that consumer expenditures rose by 2.7%, but prices increased by 7.8%. So what we have here is the US economy continuing to grow, but inflation is higher than the growth of the US economy, causing us to have this negative GDP. Now, it's really important to understand that even if we do enter a recession, even if Q2 is negative as well, this is what's known as a paper recession, meaning it's only a recession on paper. You have to understand that the GDP is still growing. We're still going up every quarter of a year. So the economy continues to get better. The number of people out of work remains extremely low. The only thing that's really an issue is inflation. So as the economy continues to grow, that's actually good for the economy. That's not a problem. It's not like people are losing their jobs or losing their houses. It's not like people are getting laid off or, can't make mortgage payments. It's not like that at all. The economy itself remains quite strong. But we have to record this as a paper recession, or at least in this quarter, a paper negative GDP growth because of inflation. And what that means is even as consumer spending goes up, if inflation's going up more, then even though consumers are spending more money, they're buying less items. So just as a really simple example, let's say inflation doubled. Real simple example. And let's say you wanted to buy a candy bar. And last quarter, that candy bar was $1, and you got $2 in your hand. Well, you can go buy 2 candy bars. Next quarter, you've got, say, $2.50. So your consumer spending grew by 25%. So you go to the store with your $2.50, and how many candy bars can you buy? Well, candy bars now cost $2. So you can only buy 1. And maybe use the 50 cents for something else. So your spending went up, but the amount of goods you got went down because of inflation. And that's what's happening right now is even though consumer spending is going up and wages are going up, they're not going up as fast as inflation. So people are spending more money, but they're getting less goods for the amount of money that they're spending. And as inflation continues to rise and the economy continues to contract, that could lead us to something called stagflation. Stagflation is when we have a slowdown in growth and yet inflation continues to rise. Now, before we get to that and explain why that's such a terrible thing, I do want to explain one more thing on the GDP growth and why it went down. The biggest reason why GDP dropped was a widening trade deficit, meaning imports to the United States are going up and exports are going down. Now that's actually a far more telling and much bigger red flag than just inflation being higher than GDP growth, because if that continues, that can lead to a real recession, meaning we can really have a contraction in the economy where we are producing less than we're actually importing. And that could be a really big problem. It's possible that even if we do enter a recession, say next quarter, which would be your 6 months that we need, that it starts as a paper recession and then turns into a real recession. So it's very possible that could happen. Keep in mind that even though a recession is defined by 2 quarters of negative GDP, a recession could actually last many quarters. In many cases, it could last many years. So just because the recession starts with 2 quarters of negative GDP doesn't mean that's how long it lasts. It could last much, much longer than that. The other thing I wanted to point out, and this is important right now in the immediate term, is that the GDP report is unlikely to change the Federal Reserve's plans to raise interest rates rapidly this year, including a half-point percentage rate that is expected at its next meeting in May. And here's where the real problem lies. If we do get stagflation, that means that the economy is contracting and inflation's going up. Now, normally, as inflation is high, what the Fed is going to do to fight that is they're going to raise interest rates. That's going to slow down inflation. However, as the Fed raises interest rates, that also slows down the economy and can put us into a recession. But what happens if we're already in a recession? Well, during a recession, the Fed will normally lower interest rates, and by lowering interest rates, it causes the economy to start recovering and going up. So here's the problem. If the Fed has to lower interest rates to get the economy out of a recession, and they have to raise interest rates in order to slow down inflation, what happens when you have both a recession and inflation happening at the same time? Does the Fed raise interest rates in order to slow down inflation and make the recession worse? Or do they lower interest rates in order to help get the economy out of a recession and in turn make inflation worse? That's the problem. And the Fed is in a very tough spot because they really screw things up whether they raise interest rates or lower them. They don't have any winning game plan at all in that sort of situation. And unfortunately, that's exactly what we saw during the period of the late 70s and early 80s. It was a constant fight of the Fed trying to lower inflation while also getting us out of recessions. And that's why we ended up seeing 3 recessions over a very short period of time back in the late 70s and early 80s. It was a time where we had very high inflation and multiple recessions. It was a zigzag pattern where we start out with high inflation, the Fed starts to raise interest rates in order to stop inflation, that sends us into a recession, so the Fed starts to lower interest rates in order to get us out of the recession, that causes inflation to go back up, the Fed starts to raise interest rates again, that causes another recession, the Fed starts to lower interest rates to get us out of the recession, that causes more inflation, the Fed starts to raise interest rates again to get us lower inflation, that causes another recession, the Fed starts to lower interest rates again. That's what happened during the late 70s and early 80s. And there's a very real possibility we could be headed for that right now. Nobody expected GDP to go down with inflation so high. So if we do in fact have a real recession with increasing inflation, the Fed is going to be in a very difficult spot, and we will most likely run through this period for the next 6 years or so where we're constantly teeter-tottering between high inflation and recession. So this is why it's such a big deal and why it's really very, very, very bad news for the markets. However, I do want to point out this is a little bit more of a longer-term concern. Right now it's a paper, and it's paper negative GDP, so it really isn't going to affect things that much, which is why we saw the stock market pretty much blow it off on Thursday. However, if it turns into a real recession, which it very well could, especially if we start getting the housing bubble burst, which everybody pretty much expects is going to happen, and the Fed starts raising interest rates more, and that causes a further slowdown in the economy, we could enter a real recession. So just keep your eyes out on that. It could be much worse than anybody predicted if we do in fact enter stagflation, and now we have a big red flag that that might actually happen. All right, now I want to move on to some Twitter news real fast, and then we're going to get into the earnings, which were more extremely bad news. There was an article that came out in the Wall Street Journal earlier today saying that Elon Musk's Twitter funding puts more of his Tesla holdings at risk. The reason being that in order to help finance his $44 billion purchase of Twitter, Elon Musk had to borrow $12.5 billion, and that's backed by more than $62 billion worth of Tesla shares, or about 40% of his total stake. And of course, in addition to that, Elon Musk also has to come up with $30 billion of his own money, which most people think is going to start selling Tesla shares in order to come up with that $30 billion to buy Twitter. Now, if anything happens and Tesla's unable to pay back that $12.5 billion loan, then what that means is the banks could start selling his Tesla shares, and that could cause the price to go down further. Now, obviously, Tesla's been dropping in price in anticipation of Elon Musk selling some Tesla shares in order to buy Twitter. And late Thursday night, we actually got confirmation that that's exactly what is happening. Elon Musk sold around $4 billion worth of Tesla shares so far. Now again, he has to come up with $30 billion in order to buy Twitter, so $4 billion is just a start, and we could see significant selling on Tesla over the next few weeks as Elon Musk sells more shares in order to fund his purchase of Twitter. All right, now let's get into the earnings that came out after the market closed on Thursday, and we're going to start with the largest company in the world, Apple. Now, Apple actually beat earnings. They reported an earnings per share of $1.52 versus $1.43 estimated. They also reported revenue of $97 billion versus only $93 billion estimated. So to put it lightly, Apple blew earnings out of the water. And the stock rose about 1% after hours when Apple reported earnings. However, you might have noticed that by the time the after hours closed, Apple was down 4%, and here's why. The CFO of Apple warned of several challenges for Q2, including supply chain constraints related to the pandemic and also the lockdowns in China that were really going to hurt the company as well. In fact, they said sales could drop by anywhere from $4 to $8 billion next quarter. So despite the very strong quarter from Apple, the fact that they gave forward guidance, which was really bad, and said they'd probably lose revenue next quarter, the stock fell because nobody wants to own a stock in this market that is losing revenue. Even Apple, the biggest company in the world, you don't want to hold on that stock when it's losing revenue. So that's why the stock is down 4%. And the big problem is Apple has not really fallen that much since the start of this bear market. In fact, Apple has maintained its share price pretty well. So now that we finally have Apple coming out saying that their revenue could drop next quarter, I do expect Apple to finally start falling. And being that it is the largest company in the market, we could see that bring down the entire stock market. So this is a huge red flag for the stock markets, especially the NASDAQ and the S&P 500, because Apple alone could really cause the markets to go down over the next few weeks. Now let's get into Amazon earnings, and Amazon stock fell 9% after hours after they reported a terrible quarter. Now, I talked about in yesterday's video how they were already expected to have a significant decrease this quarter, and they couldn't even beat estimates. Earnings were only $7.38 per share versus $8.36 expected, and revenue came in line with expectations, but it just could not overcome the fact that earnings were down significantly. Now, the main reason earnings were down was due to inflation. However, we can't overlook the fact that this was the slowest growth Amazon has seen since the dot-com bust in 2001. And it gets worse. Not only did Amazon post its first quarterly loss since 2015, but they also said that they are seeing a decline in shopping due to inflation, labor issues, and supply chain challenges. Now, this is really bad because even though Amazon raised prices to try to overcome inflation, they just were not able to raise their prices enough in order to have an increase in earnings. So unfortunately, Amazon saw a terrible quarter, and it was really telling the fact that spending on the platform went down, that consumers are buying less products. So I really want to talk about that and kind of point that out because it's a huge indicator that we are starting to get a real slowdown in the economy, that we may not actually be in a paper recession. We could actually be in a real recession right now. So this could be really bad news. Essentially, Amazon, we knew they were going to have a bad quarter because of their Rivian write-off, but what they were essentially saying was not only was it the Rivian write-off, it was also continued supply chain issues, inflation, but most telling was a slowdown in consumer spending, which means people just aren't going on the platform that much and buying products. So it does look like people are cutting back not only on the stuff that they buy in stores, they're also cutting back on things that they buy online. Now, of course, this negative report also sent Shopify down, even though they've already reported earnings, because it looks like future growth just isn't going to be there. And Amazon could continue to report continued declines in revenue growth as the next few months go on. And of course, you can't have the largest company in the world and fifth largest companies in the world by market cap drop 4% and 9% respectively and not have it affect the stock market. Nasdaq futures were down quite a bit after these earnings, and combining with the negative GDP growth, it looks like people are going to finally wake up to the fact that we are, in fact, having a slowdown in the economy, and earnings, which is what the stock market is based on, are not going to be good going forward. And just to show you guys a few other earnings that came out, Intel beat on earnings, but again, they offered disappointing future guidance, and that stock was down after hours. And Robinhood shares continue to fall as well as retail traders leave the stock market and they are seeing shrinking revenue and fewer active users. No surprises on Robinhood, but again, just more telling signs of a slowdown in the overall economy. Now, what does all of this mean for you and the stock market, and how can we profit from it? Well, actually, it's pretty simple. With people waking up to the fact that earnings are actually going to slow down, they're going to start selling off stocks because you don't want to hold stocks when earnings are going down. So I do expect that Friday and even Monday are going to be pretty red days in the stock market. Now, of course, these are just a prediction. There's no telling what's going to happen. Obviously, my Amazon earnings prediction was dead wrong yesterday. So take this with a grain of salt. But I do believe that the NASDAQ and the S&P are going to go down pretty significantly on Friday and Monday. And in fact, I would not be surprised if we see the largest decline in the NASDAQ that we have seen since March of 2020. I would not be surprised if we have a negative 5% day. It just would not surprise me at all. Based upon the earnings that just came out and the GDP growth that just came out, I would not be surprised to see a massive red day on Friday and possibly Monday. So the way to play it, real simple, I plan on buying puts on QQQ and SPY, which are NASDAQ and S&P ETFs. It's really simple. That's what I plan on doing. Just going to buy some puts. If you do some technical analysis, you'll see that we have a Fibonacci retracement, which basically goes from the March lows up to the November highs or December highs. And essentially, once you drop below that below the March lows, which essentially is dropping below that 0% Fibonacci retracement level, at that point, it's a falling knife, and it could just continue dropping much further with no end in sight until we get to some sort of next major support level. So I do think that we are going to see significant drops on both the QQQ and the SPY, or the NASDAQ and the S&P, and I think those significant drops are going to come after the market closes below that 0% Fibonacci retracement level or below the March lows on Friday, and I think we'll get continued significant decline on Monday. Now, again, it's just a prediction. I could be dead wrong, but I personally do plan on buying put options. By the way, if you guys want to know everything that I buy and sell, I post all of my trades free of charge on Twitter. And then if you want to know before I place those trades what I'm actually thinking about buying and selling, and if you want to know what orders I place before they're even filled, as well as my reasonings why, I post all of that in the VIP Discord. That way you can know what it is that I'm buying and why, and you can also get in on the trades before they're actually filled, so you can make money with us. So if that's something that interests you and you want to see everything that I'm buying and selling, you want to make money with us, come join the VIP Discord. You can sign up at stockcurry.vip/getvip. The last QQQ put option I did that I sold on Tuesday, we're up 119% on, and so these are, just an example of the kind of gains people are making over there. So if you want to join us, you want to make 119% in your portfolio too. No guarantees, of course, but if you want to see everything that I'm buying and selling, then come join the VIP Discord at stockcurry.vip/getvip. Alright guys, that's going to do it. I hope you enjoyed the video. By the way, if you want to trade put options with us and you're not a US resident and you're looking for a broker that will allow you to trade put options, you can sign up for Interactive Brokers. Interactive Brokers allows options trading throughout the world. They're in over 200 different countries, including the UK, and the commissions are extremely low. It's only $1 US, $1 Canadian dollar, 4 euros, or 6 Australian dollars, depending upon where you live. I just wanted to let you know about that so you can join us on the options trades. I hope you guys have a lot of success trading. Don't forget to hit the like button and subscribe if you haven't already. And I will see you on Monday.